for a green recovery have already been invented. Low carbon energy, I'm talking to you here from Scotland, where 90% of Scotland's energy comes from renewable sources. Obviously, not a lot of solar, but plenty of wind. The technology for insulating buildings, low carbon transport, all of that exists. And now is a very good time to invest in it with low interest rates and the desperate need for new jobs.
That was the Unilever CEO, Alan Jope, speaking to Francine Lacroix at the Bloomberg New Economy Forum. Interesting to hear him talk about carbon pricing. We had that conversation with Vincent Juvens a little bit earlier on this week about the need for further focus on that. Just a quick recap for you of what we're hearing from Christine Lagarde. She's still speaking to the Monetary Affairs Committee at the European Parliament. She's finished her opening remarks. She's now answering questions from members of the European Parliament. In her opening remarks, the big message really was on the fiscal side, saying EU spending package must be operational without delay. This is all in connection with the recovery fund that seems to have stalled in its approval process because of tensions east-west with regards to conditionality attached to it. Some of the things coming through in the questioning of Christine Lagarde, the ECB president, then she's saying that the PEP, that was the monetary policy tool brought in to fight the coronavirus fallout, was targeted to be temporary and exceptional, although I will say she said earlier in her remarks that it looked like the PEP and the TLTROs would be staying around for a little bit longer. She does also say she's concerned about the Target 2 and whether there could be a technical failure there. This, as I say, in response to questions. But Target 2 is a really big payment system, of course. It's one of the world's largest payment systems. More than 1,000 banks use Target 2 to initiate transactions in euros. So perhaps another area of focus for us here at Bloomberg. Now, the UK and Canada are on the brink of signing a new trade deal. That's to replace the existing agreement Britain has through EU membership. Sources tell Bloomberg an announcement is expected within days. Joining us now is a reporter behind this story, Joe Mays, Bloomberg's UK government and Brexit reporter. Joe, very good morning. So how significant is a potential UK-Canada trade deal? Give us some size and scope on this one.
Yeah, it's pretty big. I mean, the UK is Canada's fifth largest trading partner globally, and trade between the two countries worth about £20 billion in 2019. So, yeah, it's not an insignificant sum that will be covered by this deal. And the danger was that if they didn't do this agreement, then tariffs would have applied to trade from January 1st, when the Brexit transition period ends. Because as you were saying, the UK already has a deal with Canada through EU membership, so they need to roll that over. So it's a pretty big win for Johnson in that it averts that negative outcome and kind of adds to his narrative of how Britain can do trade deals outside the EU.
What about negotiations with other countries, though, Joe? They still need to roll over, 14 other EU agreements? So taking that EU law and getting it somehow into UK law in time for January the 1st?
Yeah, so 14 in addition to the Canada deal. And, yeah, there are pretty major countries in there, like Mexico, Singapore, Turkey, and the trade combined of all those agreements covers about £60 billion worth of goods flowing. So, yes, important deals that do still need to be done. Time is running out, and indeed there was controversy in Parliament this week when the Labour Party was saying that you haven't given us enough time to scrutinise these new deals you're doing, whereas the government saying we'll probably just have to provisionally apply them, so you won't get to actually ratify them before January 1st. So clearly time has run out. But I think that they're still confident most of those will get done, but some they're not confident about getting done, like perhaps Mexico's, perhaps in the balance, as is Turkey.
How do these deals impact on the UK-EU negotiations, if at all, then, Joe?
I wouldn't read too much into the implication for the EU talks, apart from just saying, obviously, it's a kind of confidence boost for the UK, and it might make them feel perhaps slightly more willing to go for no deal if they know that they've got other trade agreements in the bag with these other countries. If they didn't have these rollover deals, then that would be adding to the impact of a negative EU outcome come January 1st. But I wouldn't read too much into it. These kind of a separate track at this point in time. I think a UK-EU deal would still be very advantageous in an economic sense. Still that question of will Johnson go for it, or will he decide that no deal is a better political outcome for him? One will have to see in the coming days.
Yeah, just how skinny will that deal be as well? So it looks as if we could get a lot of trade news then coming through from the UK, and good in the context of UK-Canada that maple syrup won't be getting any more expensive than it already is. Well, probably anyway. Joe, thanks very much. Thanks for joining us. Joe Mays with a look there at the UK-Canada trade deal that seems to be in the offing. Let's get a Bloomberg Business Flash for you. Here are today's top corporate stories at Bloomberg. ThyssenKrupp is cutting 11,000 jobs, almost twice as many as planned. It's forecasting a more than €1 billion loss for the year. That's as the industrial conglomerate fights for survival, with its steel business continuing to hemorrhage cash. Last week, Bloomberg reported it was in talks for over €5 billion of government aid. Norwegian Air Shuttle is seeking creditor protection in Ireland. That's after a surge in coronavirus cases scuppered hopes for an early recovery. Profit has proved elusive for the discount carrier, and it was already trying to rein in debt when the virus hit travel. The Norwegian government refused a second bailout earlier this month. Nvidia is warning that data center chip sales will decline slightly in the current quarter. Orders are falling from a Chinese customer that analysts speculate is Huawei. Nvidia is known for its gaming processors, but the market for data center tech has become one of the largest sources of the dollar on a Brexit trade deal. That is the macro view of Market Live's Ven Ram. We'll discuss that with him next. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
I am David Weston.
That is now being reversed.
Welcome back to the European Market Open. We are 51 minutes into the trading day, down 0.9% on the European equity market space. We've been closely following comments coming through from Christine Lagarde, ECB President at the European Parliament. Her big message really on the fiscal side, saying EU spending package, that is the recovery fund, must be operational without delay. There have been delays, of course, around conditions attached to that. She's gone on to say that the ECB has delivered in the first wave and will continue to. She's currently still taking questions from European lawmakers. Let's get to the market side of this. then Ven Ram, Bloomberg's Markets Live Currency and Rate Strategist, joins us. Ven, I wonder if you've heard anything around the Christine Lagarde a statement or Q&A today that has got you changing your thinking. I see that the euro is down a touch now, 118.27, down 0.2%. But really, there was a strong dollar story going on the evening Asia time and into Europe.
Morning, Anna. Yes, I mean, there's not been much of a reaction, I would say, to Christine Lagarde's statement this morning because this is the third time this week she's spoken. And basically, she's been reiterating the message from the October meeting where they said that, look, I mean, the December meeting of the ECB is going to be a big bazooka one where we should expect big changes, particularly in terms of expansion of the PP envelope. And that message seems to have been reiterated over and over again. And, of course, she will reiterate that the fiscal side of things need to add up as well. So I'm not surprised by what she's saying. Both factors are supportive of the euro and for bonds as well. Anna?
Yeah, I mean, she's saying that she said today at the European Parliament, she's promised a forceful monetary stimulus package for December. Do you think the market expected that already? She's also gone out of her way to make the point a couple of times this week that it's not just the size of the package the ECB delivers that matters, but its longevity. Is that part of the market's thinking at this point?
Yes, it is very much part of the market's paradigm that's been assumed for a while now, because they've previously expressed opinion that they are in favor of expanding the PPP, not only expanding the amount of purchases, but also the longevity of the program, because they've been working so well for the markets. If you remember, since the days of the tumult in March, bonds and other peripheral bonds have come a long way, and it's been very supportive of the peripheral bonds in particular, and the ECB likes what it sees. And therefore, they have every reason to continue with the program for longer than expected, and that will prove supportive for peripheral bonds. Anna?
Yeah. Let's move on and talk about what's going on with the pound then, Ven. It's actually weaker today, down around 0.5%, but still above 132. You've been writing a macro view piece talking about how the pound could strengthen on a Brexit trade deal. I also read earlier this week a survey of strategists that suggested the pound could weaken around 5% on a no deal. So is that the range of movement we're talking about here, 5% down or 5% up, depending on whether we get a deal or not?
Yes, it very much appears so that would be the range, Anna. The pound has conventionally had a pretty strong negative correlation to moves in the broad dollar. Given that the dollar has fallen some 4+% this year, the pound ought to have rallied by almost 5%, given its beta to changes in the dollar. However, that hasn't happened at all. And in fact, the pound is pretty flat on the year, as you know. To me, that suggests that the currency is being held down by uncertainty surrounding whether or not we will get a post-Brexit, post-transition Brexit deal. After all, we have seen so many twists and turns to the story. But if we do get a deal, we may see the pound rally to the extent it has been held down, so roughly about 5% against the dollar. On the other hand, as the survey showed, if we don't get a deal, I think it may eminently fall down to 127 or even 125 perhaps against the dollar. Anna?
Ven, thank you so much. Ven Ram joining us there from the Markets Live team. Let's close out the hour with a quick look at these markets, down by 0.9%. It seems that value sectors leading us downwards, European stocks dropping as rising virus restrictions overcome promising vaccine news. That seems like a good way to sum things up. And the vaccine news was admittedly pretty backward looking. It was phase 2 data, not the phase 3 data we're looking for from AstraZeneca and Oxford, although that will come in coming weeks. And that's something that we need to, of course, look out for. So European equity markets, as I say, on the back foot, down by 0.9% or so. US futures actually worsening as we go through the session as well, now down by between 0.5% and 0.6%. Just looking at the latest lines coming out of Christine Lagarde's briefing to the European Parliament, she's still taking questions from European lawmakers. She gave us her statement, and that very much focused on, yes, the monetary side of things, the role of PEP, the role of TLTROs, but also on the fiscal side, the need to get that recovery fund agreed agreed. She certainly made that point, and she's gone on to take questions from lawmakers. She says the ECB delivered in the first virus wave, and it will continue to. You can watch her on Live Go if you have a terminal. This is Bloomberg.
The vaccine race. A phase 2 study confirms that Astra-Oxford vaccine provokes an immune response in elderly patients. A phase 3 trial looking at its results is expected within weeks. U.S. deaths from the coronavirus reach 250,000. New York City shut schools once again. The country deals with a surge in cases from coast to coast. And EU leaders will attempt to salvage billions in virus relief today. Hungary and Poland threaten to derail the plans with vetoes. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, a lot going on because you have Christine Lagarde testifying to members of Parliament. So we, of course, continue watching that testimony and we'll bring you anything that comes out of it. The market's focusing on infections rising across the world. They're also, focusing on the fact that we could see a stimulus. Let's get straight to the markets. So let's go to the markets. I don't know if we have them, but if we have them, it'd be great. And it's a good time to look at them. The focus is firmly on dollar. The dollar is actually advancing. If you look at stocks overall, they're falling alongside U.S. futures. Tougher restrictions to curb the pandemic's resurgence overshadowed progress towards a vaccine. Treasuries advancing with the dollar. So we'll have plenty more, of course, on that. I'm also looking at AstraZeneca rising after releasing some positive results on its COVID-19 vaccine. In the meantime, we're also hearing from Christine Lagarde. We had also an exclusive conversation just days ago. For the moment, her comments not moving the markets, but very interesting nonetheless. The focus is on the need for stimulus. The focus is also on the need for markets to come and do a little bit more. She said that basically the ECB delivered in the first wave and will continue to do so. She also talked about the fiscal packages, saying that the EU packages are important for fiscal monetary coordination. Now let's get straight to our other top story. And a study confirms that AstraZeneca Oxford vaccine provokes an immune response in the elderly. The phase 2 study published in The Lancet doesn't assess the treatment's efficacy, while a phase 3 trial is expected within weeks. Joining us now is Richard Horton. He's editor-in-chief at The Lancet. Richard, always great to speak to you. Thank you so much for joining us. When do we actually say that this AstraZeneca Oxford vaccine is a success, like we've heard from Moderna and Pfizer?
Well, we'll definitely be getting the phase 3 results from the Oxford AstraZeneca vaccine before the end of the year. But this is a very important step because the big worry with any vaccine is that it doesn't work so well in older people. And of course, it's the older age groups who are particularly at risk of harm from this coronavirus. And the fact that, as you said in your headline, that this vaccine does provoke a strong immune response, this is great news. It's another step, another brick in the house that we're trying to build for this vaccine.
Richard, how is this vaccine different to the other ones, right? This is not an RMNA that we heard, which is a new type of vaccine. Does it make it easier, if it is a success, to distribute?
That's right. We've got 11 vaccines currently in late-stage clinical trials right now. And the great thing is that we've got different types of vaccine across those 11. The Moderna vaccine and the BioNTech vaccine, they are mRNA vaccines, as you say. This is not. This is where you take the spike protein on the virus and you attach it to another virus, an adenovirus, and that gets you entry into the cell, which provokes the immune response. There are two other categories of vaccine, an inactivated vaccine and a protein-based vaccine. So this is giving us lots of opportunities for different types of vaccine, all with slightly different advantages and disadvantages. The good thing about the Oxford vaccine is that you don't need minus 70 degrees to store and protect it. It will be much easier to distribute, and that's good for the global challenge that we face.
Richard, what do you think is the biggest challenge we face right now? Is it misinformation? I don't know whether there should be another channel of information, which means that everybody actually understands what these vaccines are or not. You know, everybody comes on various TVs and actually almost says what they want about these vaccines.
Yeah, I think there are two challenges. One is simply the manufacture of 15 billion doses, which has never been done with any vaccine, because these vaccines, you have to give 2 doses per person. So 7 billion people on the planet over, you're going to need 15 billion doses. That's huge. But the second challenge is the anti-vaccination movement. The anti-vaccination movement has mobilized, it's growing, it's active, and it's dangerous. And we need to see governments, we need to see public figures really working hard to defeat this movement. The vaccine science is good, it's safe. We need to take it one step at a time, no cutting of corners, but we have to protect the progress we've made. And the anti-vaccination movement is a threat to that progress.
But Richard, the anti-vaccination movement goes as far as, I was reading statistics, I mean, 45%, I think, of people in France wouldn't take this new vaccine. The numbers are pretty similar in other countries in Europe and in the US. Who's the right person to actually, is it regulators that need to step up in talking to the public? Who's the right person to make the case that these vaccines are safe?
We need everybody who has leadership role in government, in science, in business, our schools, every part of society needs to be giving the message that the vaccine science is safe and we are going to have an effective vaccine soon, and people should trust in that vaccine. So it's not just one person, but I would say that the responsibility of our political leaders is to really build trust with the public. As soon as you have distrust, it's distrust between the public and authorities that then leaves the space for anti-vaccine propagandists to exploit. So if I think about President-elect Biden coming in, his number one objective for him and his advisory group that he's formed is to rebuild public trust. And then you can protect that progress that we're all hoping for in 2021.
Richard, are you confident that these vaccines, be it the Pfizer, the Moderna, or this AstraZeneca Oxford one, will protect people for a long time? Or could you actually produce an antibody response that only lasts for a couple of months?
Oh, well, you just asked the $100 million question. And the honest answer to that is that we don't fully know. Coronaviruses that we know of exist already. You usually have immunity once you've been infected with those for about 40 weeks, so about 9 or 10 months. So it's likely that this vaccine will give you immunity for a year, but you may well have to have another vaccination the next year, just like we have with influenza. The good news is that it's unlikely that you'll have to have a new vaccine every year. So influenza, of course, mutates, evolves, and you have to have a different vaccine every year. It's likely that that won't be the case with this coronavirus. But honestly, we can't be 100% sure at the moment how long immunity will last, but my guess will be it will be around a year.
Richard, thank you so much for all of the insight. Richard Horton, their editor-in-chief at The Lancet. Now, coming up, New York City shuts schools and warns of a crippled public transport system. We'll round up the latest on the coronavirus and discuss vaccine optimism and the markets. That's coming up shortly, and this is Bloomberg.
It came in better than expected, not only in terms of job creation, but also a sharp fall in the unemployment rate consistent with higher labor force participation. That's really good news.
Overall, the gain was solid, but even while this is a very robust pace of job gains, it's a lot slower than it has been in the summer months.
Great that we saw the job gains we did, but they still are diminished from what they were, of course, back in April and May. And the scarring, the sort of wounds that were created by COVID are beginning to fester.
I would caution people to look at the top line number because I don't think it tells the entire story. Employment relative to population is still well below where we were pre-crisis, and that's because I think that we're going to have some lasting damage.
Depending on what you look at, jobs creation or the unemployment rate, you have different views as to whether the improvement in the labor force is keeping up or slowing down.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
We've been shouting from the rooftops for a very long time. There is a monopoly problem in this country, and in particular, there is a Google problem in this country.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Let's get straight to the Bloomberg First Word News. In our office is Leanne Gerrans. Hi, Leanne.
Good morning, Francine.
Tensions are rising among oil producers, with the United Arab Emirates privately floating the idea of leaving OPEC+. It is unclear if this is a warning to force a debate over production levels or a genuine plan of action. There's been friction with neighbouring Saudi Arabia since the summer, when the UAE increased output above its OPEC quota. Now, the UK and Canada are on the brink of signing a new trade deal. That is to replace the existing agreement Britain has through EU membership. Last year, trade between the two nations was worth about £17 billion. Sources tell Bloomberg an announcement is expected within just days. And Tokyo is raising its virus alert level to the highest level after new cases hit a record high. The US is facing another grim milestone with 250,000 deaths. But there's better news closer to home. In France, hospitalizations are down, with the number of intensive care patients falling the most, and that is since May. Global news 24 hours a day, on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thanks so much. Now, we've just been discussing vaccine hopes, but more restrictions loom over the recovery. New York City has shut schools and faces a crippled transit system as deaths in the U.S. have now topped to 150,000. Well, the Chancellor Angela Merkel is warning that the situation remains very serious. In Germany, and UK Prime Minister Boris Johnson has been advised to consider regional curbs after the national lockdown. Well, joining us now to discuss all of this and the impact on the markets is James Bevan, Chief Investment Officer at CCLA Investment Management. James, as always, thank you for joining us. There seems to be a short-term concern about lockdowns, but then the market is focusing on the long-term hopes of a vaccine. It feels very binary. What are the markets misunderstanding?
Well, I think the markets correctly anticipate that if governments and central banks are taking COVID-19 seriously, there will be more support. So I would expect central banks to maintain ultra-accommodative policies with very low interest rates and more non-traditional measures such as quantitative easing, and also the funding of government deficits. I would say if the age of austerity has passed, governments will spend more money, and companies are going to benefit from an environment where consumers are supported by government handouts, and that the capacity to look forward to the post-COVID world does provide a sense of optimism.
James, when you look at the big rotation, or the start of the big rotation that that started a couple of weeks ago, what will be the catalyst for it to continue? Does it just continue naturally?
Well, market participants who have shifted into value and cyclicals out of higher quality and growth-focused companies are in essence betting that the worst is past, that the year-on-year comparisons will be relatively straightforward, and therefore the bombed-out sectors and companies from this year will be the star performers of next year. Now, for that to continue, we need three things. We need to see companies confirming that they are experiencing a better tomorrow than yesterday. And I don't think that's going to be difficult. But it is very easy for markets to run ahead of themselves and to buy the hope rather than the reality. The second issue is that we have to see continued supportive policy of richer valuations, so low interest rates, relatively low inflation, and a continued commitment by governments towards the generation of decent asset returns. And that's very much been the vox populus of central banks in recent years. The third issue is we have to see the base plate, household confidence begin to rebuild. So we have to have continued good news on COVID-19, and we have to see the savings rates that have been high begin to dissipate and turn into real spending.
James, is there a concern that actually there's not going to be, enough monetary support, central bank support, if we don't have fiscal spending? Is there a danger that if we get a vaccine, the market is mispricing, the start of very slow but normalization?
I absolutely concur that there is a risk that central banks can end up pushing on a piece of string. They can provide credit, they can provide liquidity, but the velocity of circulation of that money can be very, very slow. And that means that central banks will progressively deliver lower bang for the buck in terms of monetary support. So it is critically important that governments are prepared to spend money. Madame Lagarde of the European Central Bank has made this abundantly clear. We see this in the UK, where Chancellor Sunak is being bankrolled by the Bank of England. And I do believe that the CAS Act, passed into law by Team Trump on the 27th of March, simply would not have been possible had we not had the unlimited quantitative easing brought in by the Federal Reserve on the 23rd of March. So for the US, there's a real issue as to how much will Team Biden be able to spend next year. My bet is that they will be able to spend at least $1 trillion, and that will be sufficient to drive the US economy to genuine recovery mode.
James, what do you do with inflation in that case?
Interestingly, I think inflation remains remarkably low. I think it is now on an upward trajectory from very low levels, but there are some structural issues that will hold inflation down. Deteriorating demographics, globalization, which continues to be a force despite the fact that it is less than it was, aging populations as part of demographics, but also part of the indebtedness challenge that so many economies face, and of course, disruptive technologies. And against this backdrop, I think that the really big issue is, will companies invest in additional productivity? And if they do, inflation stays low.
James, thank you so much. James Bevan there from CCLA Investment Management stays with us, and we'll have plenty more, of course, on Europe and some of the concerns there with the budget. Coming up, EU leaders gear up for what looks like a grueling battle to salvage billions of euros of pandemic relief. We discuss that next, and this is Bloomberg.
So when you went to Baltimore, you went initially to be an anchor woman, and then it didn't quite work out.
Yeah, I got fired.
Well,
demoted.
You got demoted, but they didn't. They had a contract, so they didn't say goodbye. Yeah. And then, how did you work out to be on a afternoon show where you actually got to be an interviewer? How did that actually happen?
Well, what happened was this is what I now know with age and perspective, that many times getting demoted is an opportunity for something else to show up, or getting fired. You know, lots of people I've interviewed over the years who have these stories about the best thing that ever happened to you. It puts you in the next best place. I was not a good television reporter. I was too emotional. I was making $22,000 a year, and my best friend Gail, who I met there at the time, she was also working there. She said, "Oh my God, you're 22, making $22,000. Imagine when you're 25." Then you're 30. So I'd be making 60 about now. It'd be good, 62. Once I got demoted, they didn't want to pay out my contract. I was making $25,000 a year. They didn't want to pay me the $25,000. Right. So they kept me on and said, "We'll put you on this talk show just to run out your contract."
This new law that came down from China's National People's Congress Committee ended up leading to the disqualification of 4 pro-democracy lawmakers.
This is probably the very final and complete crackdown.
I hope you understand it is not anything new at all. This was supposed to happen.
We're not just going to snap right back to the previous economy. I think that's unrealistic. There are people, though, that need to be retrained. This has accelerated, for example, trends in retail. right? We've seen that. So we're going to have to figure out how to retrain that workforce.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
This is Bloomberg Surveillance. I'm Francine Lacquet here in London. Now, the European Union is facing what looks like a grueling battle to persuade Hungary and Poland to pull back threats endangering billions of euros of pandemic relief and budget funds. With much of the continent in lockdown, the two Eastern European countries say they'll veto a key plank of the bloc's economic recovery package, while France says Poland and Hungary could be cut out of the rescue plan altogether. Well, still with us is James Bevan from CCLA Investment Management. James, I have a lot of questions regarding Europe and regarding Brexit, but first on this possible veto. What does it tell us about the economic recovery in Europe? Right after the summer, a lot of investors were extremely optimistic about Europe. Is that going to change?
I do feel that there are some serious fault lines within the construct of the Eurozone. And as Madame Lagarde has pointed out, what we have to have is fundamental reform of the Maastricht Treaty in terms of who can spend what. We need to have mutualisation of debt. Italy, I think, is a particular challenge. People seem to have forgotten about Italy's budget balance and challenges. And I would observe that the Italian economy certainly needs a lot more spending than is permitted under EU rules. So I absolutely concur with the perspective that is now beginning to circulate in the market that the Eurozone project is still very much at risk.
James, what does that mean for Euro?
I think that the euro has the capacity to strengthen against both the pound because of Brexit risk and, interestingly, against the dollar as the US determines its post-COVID strategy under the Biden administration. But I think that that recovery can be quite fragile. So I suspect that what we will observe for the next 12 months is much greater volatility of currencies than we have experienced. And that currency volatility will go hand in hand with market volatility more generally.
James, when you look at some of the big companies in Europe, is there any value to be made? I mean, it's still one of the regions that's really trying to focus on a green recovery. We also heard from Christine Lagarde about what she wants to do with bond buying purchases, focusing on green things. Is that something that you want to be invested in?
Oh, absolutely. I do think that there is a following wind from environmental, social and governance factors as people determine that a combination of legislation, regulation, litigation and customer and supplier action means that higher environmental standards will be forever more pressing at the company level. That to me means that we should be focusing on companies like Schneider Electric, which is clearly a play on electrification, as well as more widespread recovery. I think that the play in Europe that looks particularly risky at the moment is going back to support the European banks. I struggle to understand how mainstream European banks will be able to make money in a climate of really adverse sentiment and, of course, negative interest rates on an ongoing basis.
Is there anything else that we should be looking at, James? When you look at Brexit, so there's another deadline looming. We don't know whether we get a deal. Have UK assets been oversold?
I would say that there are bifurcation of opportunities within the UK. There are the global companies, the Diageos of the world, the Unilevers of the world that I think will prosper in the long run as global companies. They just happen to be quoted in the UK. There are other companies that are not UK companies but will benefit from the UK domestic economy reopening, companies such as Heineken. I then think that there are opportunities within the UK domestic economy that will reflect what happens with domestic policy. And I'm thinking particularly of the UK house builders, companies such as Bellway, Barratt. And here I think that we are observing Mr. Sunak, the Chancellor of the Exchequer in the UK, determined to support economic recovery. Bank of England holding money rates low and likely to announce an additional 100 billion of quantitative easing next year on top of the 150 billion that was announced in the Monetary Policy Committee meeting in November. Now, against that backdrop and relatively fixed supply, I don't think the housing market will fall back. I think there are opportunities for house builders.
Great. James, thank you so much. James Bevender, Chief Investment Officer at CCLA Investment Management. We'll be back with plenty more on the economy. This is
our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Good morning, Francine. The COVID vaccine being developed by Oxford University and AstraZeneca shows a strong immune response in older adults. That's the latest from an early study. Pivotal stage 3 results are expected in the coming weeks. They'll determine if it can meet the high bar set by frontrunners Pfizer and Moderna. Now, New York City is closing its schools after the positive test rate hit a critical threshold. It's also warning of 40% cuts to the subway without aid from Washington, and more bad news could be coming. Governor Andrew Cuomo says if the infection rate increases, indoor dining, gyms and other non-essential businesses could also close. Australia says it won't compromise after Beijing ramped up criticism of the government. China is outlining 14 grievances, including the nation of poisoning bilateral relations. Tensions have been escalating since Prime Minister Scott Morrison led calls for an inquiry into the coronavirus outbreak. China has hit the nation with a wide range of tariffs. And PIMCO is being sued by a pair of female workers who are accusing the money manager of having a fraternity culture. They say the company marginalizes, demeans and undervalues women and encourages gatherings at strip clubs. The suit says the expectation is that women must choose between having children or excelling in their career. PIMCO strongly denies these allegations. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Thank you so much, Leanne. Now, all week, we've been bringing you big conversations from speakers at the Bloomberg New Economy Forum about life after the pandemic. The BlackRock chair and chief executive, Larry Fink, spoke to us about the need for U.S. stimulus and what the election results will mean for the markets.
I would say overall the market likes a divided government. They want to make sure there's proper checks and balances. We've seen in the past when we have a government that is totally controlled by one party, we have actually seen more extreme in terms of positions that they've made. And so I think a divided government, but also I do believe strongly that the market is in desire of more stability, of less volatility. They're looking for a voice that moderates, not a voice that incites. I truly believe President-elect Biden can be that voice of reason. He can, and if we all listen to his speech last Saturday where he was talking about one America, not a red or blue. And so I think the marketplace is encouraged by having a leader now that is more inclusive, a leader that could probably bring a little more global harmony. And I think we're all tired. We're tired about all the volume we hear out of Washington. We're obviously very tired about COVID. And we are worried about where we are going right now in these coming weeks. And so we're looking for a new leader to help us navigate COVID and moving forward. We're looking for a leader who has a stronger opinion on climate and is willing to work with the world on moving forward, both in climate and all other global issues that are facing our world today.
The markets are assuming, I believe, that a stimulus bill of at least $1 trillion will pass in the lame duck, and that maybe another stimulus bill will happen early in the administration. If there were to be no stimulus bills of size, do you think the markets would take a very bad reaction to that?
I would take a very bad reaction. Whether the markets we would, let's see, but probably. I think we as an economy and most developed economies are over-reliant on monetary policy. And we are heavily, and because of monetary policy, we've seen great support to the capital markets, and we've all been benefiting from that. If we want to create a more equalized economy, we have to do targeted fiscal stimulus. If we're going to just rely on monetary policy, that is another example that's creating more and more income inequality, because those who own equities, those who own financial assets are generally wealthy people. The poor do not own financial assets. And so we have the divide, because of the strength of the equity markets and the job losses that we've witnessed, has really created even more of an income inequality. Now, I'm fully supportive of monetary policy, so let's be clear. I believe what Jay Powell and the Federal Reserve has done has been nothing but amazing. But if we are going to try to really rebuild our economy, we truly need a very targeted fiscal stimulus for those who are still unemployed. We need to do a fiscal stimulus for some of the cities that are most impacted. And I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy. And that's going to be essential for the Biden administration.
If we do have a stimulus bill that's significant, that's going to increase the debt. It's already $27 trillion, and the annual deficit is about $3.2 trillion. So in terms of money we're borrowing right now. So how can we afford this? And why are the markets not worried about this enormous amount of debt and annual deficit?
Well, I would say we should worry about it, but it's not a major issue today. We're not witnessing inflation. If anything, you could see from the private equity side, we see that from full alternatives and liquid markets, that there's actually a shortage of high quality investments right now. And so I would say the markets are correct in not worrying about the deficits today. What we do need is, through stimulus, we need to get growth going. And as we get growth, then this deficits that it'll ultimately be probably north of $30 trillion. These deficits are going to have less impact if we have a broader, larger economy. If we can't find a way to create growth in the coming 5 years, then we are going to face the impact of this rising deficit. And at the same time, in the next 5 to 10 years, we are seeing an aging global population, especially from Japan and China. They're going to go from savers to spenders as their economies as their population becomes older and they're retiring, and they're going to be utilizing that savings for living in retirement. And so this is going to be a problem if we don't find growth.
Well, that was the BlackRock chair and Chief Executive Officer Larry Fink at the Bloomberg New Economy Forum. Now, coming up, we speak to the Schneider Electric Chief Executive, Jean-Pascal Tricoire. That's an exclusive conversation focusing on the green transition. This is Bloomberg.
Real downside over the next 2 quarters is, does the resurgence get so bad it forces lockdowns because of overwhelmed healthcare systems throughout the country? That's what we're watching.
This is Bloomberg Surveillance. I'm Francine Lacroix here in London. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Good morning, Francine. ThyssenKrupp is cutting 11,000 jobs, almost twice as many as planned. It's forecasting a more than €1 billion loss for the year. That's as the industrial conglomerate fights for survival, with its steel business continuing to hemorrhage cash. Last week, Bloomberg reported it was in talks for over €5 billion of government aid. Now, Norwegian Air Shuttle is seeking creditor protection over in Ireland. That's after a surge in coronavirus coronavirus cases scuppered hopes for an early recovery. Profit has proved elusive for the discount carrier, and it was already trying to rein in debt when the virus did hit travel. The Norwegian government refused a second bailout. That was earlier this month. And Nvidia is warning that data center chip sales will decline slightly in the current quarter. Orders are falling from a Chinese customer that analysts speculate is Huawei. Nvidia is known for its gaming processors, but the market for data center tech has become one of the largest sources of revenue. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Leanne. Now let's bring you another interview from the Bloomberg New Economy Forum at a panel on pathways to a low-carbon energy future. Speakers will discuss the need for resilience and sustainability in the face of coronavirus. Well, my next guest also spoke at the forum. He also runs one of the world's biggest industrial companies. Joining us now for an exclusive conversation is the chief executive of Schneider Electric. He's Jean-Pascal Tricoire. Monsieur Tricoire, thank you for joining us today. When you look at COVID and the implications longer term, will it really effectively help with the transition towards a greener economy, or is this just all talk for the moment?
Hi, Francine. Well, I don't know if you can directly correlate COVID on green and transition to green, but you can establish a path from one to the other. We see, and we believe at Schneider, that one of the biggest catalyzers for the green economy will be digitization. That will make everything around us much more efficient. And you see it in the names of all the elements that participate to a greener future: smart grid, smart buildings, smart manufacturing, smart homes, smart infrastructure. Everything has to be much more digital to have a step change in efficiencies that drives to carbon reduction. And from that point of view, the COVID has been a massive accelerator of digitization for several reasons. People wanted to remote operate a number of things. We all face issues of resiliency, being able to remote operate installations while operators couldn't go on site. All of this makes that for Schneider, for instance, the pace of digitization of systems which enable digitization for our customers has increased dramatically in the past 7 months.
But what about demand for electric cars? Have they caught up in Europe? I know, you're one of the makers of the EV fast chargers. How have sales in that category gone?
Well, you make a very important point. Is speak about the COVID. So it has accelerated digitization, and I believe because people have kind of seen the origin of the COVID, which is density of population. Particularly on globalization, as the same as the one which is driving to climate change. We've rather seen an increase of awareness for sustainability. And let's not forget that before COVID, which is the beginning of the year, sustainability was really the big item of the agenda of companies and society. So we've seen this sustainability subject has only grown during the COVID. And when you look at the way to resolve the issue of sustainability and make the world more sustainable, it's about digitization, and I spoke about that just before. And the second one is electrification, because electricity is the only energy that allows decarbonization. So if you combine those two, digitization and electrification, which is not the same electricity as before, it's renewable, it's decarbonized, it's decentralized, and it's digitized, then you have a path to sustainability. So you're perfectly right. We see today an acceleration of electrification, not only on vehicles, but also in buildings. You've got more countries today in Europe, for instance, which are passing rules or regulations that will make that buildings will be all electrical. So we see at Schneider a future which is all digital and all electrical to be more sustainable.
Yeah. But Monsieur Tricoire, does it start actually with the focus on cars? Are you cheering the ban from the UK on combustible cars, and also all these incentives from Germany on cars? Again, how much of a difference does that make? Does it bring the transition forward by 5 to 10 years?
Look, it's an important part of the transition. I mean, transportation represents 30% of carbon emissions. Among those, some parts are difficult to substitute. I mean, fossil fuels are difficult to substitute. But if you speak about cars, the adoption of electric vehicles seems to be accelerating, and for very good reason. The energy efficiency of a car, which sources its electrons from a carbon-free source of electricity, would it be renewable or nuclear, is excellent. It's above 90%, while a fossil fuel car has an efficiency which is around 30%. So we see also that with the evolution of technology, the price of an electric car will be lower than an ICE, probably at the horizon of a few years, 2 or 3 years. So clearly, there is a very promising path for electric cars. And electric cars, because they don't emit carbon, they don't emit particles, will create cities which are much more silent and much less polluted. So that's one part. But building will know the same kind of evolution.
When are we going to see more investment in industries? Is 2021 the right date? Are you hearing the right noise in terms of U.S.-China, trade? Will a Joe Biden administration make a difference? Do vaccines directly make a difference on how much people invest in industrials?
Well, you're going to see some industries. The world is quite bifurcated at the moment. Some industries are suffering. Some industries are getting accelerated by the COVID. So the dynamics are very different from one segment or one market to the other one. Then there is a more structural, fundamental element of evolution, which is Industry 4.0. Industry 4.0 changes quite dramatically the way we manage manufacturing. Especially the world of IT is merging with the world of operation. And therefore, you've got a lot more software in the process of industries. And that was a movement that had started before the COVID. So when we speak to our customers today, they always have two big agendas. One is sustainability, and the other one is digitization. And the good news is that they go together, and we can mix those two into one consistent agenda. But look, I mean, in industry, we've seen at Schneider the massive displacement of the interest of our customers to software. And remind you that 3 years ago, we created a company called Aviva, actually merging the software business of Schneider together with Aviva, which is listed in the UK. And that has been a tremendous success. And actually, during the summer, we realized the acquisition of another company called OSI Soft, which is complementing very nicely our setup in software, which allows our industrial customers to completely digitize their process. But aside COVID, aside that agenda of Industry 4.0, everybody has realized recently, including tensions between geopolitical blocs, that supply chain needed to be more local. And it's partly because of trade tensions, but it's also because if you want to reduce your carbon footprint, you need short supply chain. And if you want to serve your customer in a personalized manner, also in a customized manner, and create a difference, then you need also short supply chain. And digitization allows you to manage smaller and more regional supply chains.
Thank you so much, Mr. Jean-Pascal Tricoire, there, the Chief Executive of Schneider Electric. We'll have to get you back on. We're short of time today. Now, coming up, we'll have plenty more on some of the emerging markets. It's already also cut its benchmark rate by 300 basis points this year. We'll look ahead to the rate decision from South Africa's central bank. That's coming up shortly, and this is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's talk about South Africa and its sovereign debt. Speaking to us on the sidelines of an investment conference in Johannesburg, President Cyril Ramaphosa said the government is in talks with unions on freezing wages for 1.3 million state workers as it tries to control spending.
I'm certain that we will be able to bring our debt levels down and avoid what you could call a debt crisis, because we are focused and we've been open enough by telling the nation that we have too much debt, and a country that needs to grow needs to reduce its debt.
Now let's get more with our Danny Berger. Danny, just how dire is South Africa's debt situation right now?
Well, look, this is something that both economist and Ramaphosa himself has pointed out as being troubling for the country. Since 2008, the debt of the nation has doubled, and all expectations are that it will continue to grow. And this has really put South Africa in a place where they need to reform or else face a sovereign debt crisis. Even going into the coronavirus crisis beforehand, they already were facing recession. They already were seeing unemployment at a 17-year high. But what the coronavirus did and the accompanying shutdown was made it really hard to collect taxes. And this only exacerbated the debt crisis that South Africa was facing. They've done things that they haven't really historically done, like take a loan from the IMF. And a lot of this debt is also tied to Eskom, the big state utility power company. And that's something that Goldman Sachs has said is the biggest threat to South Africa. But one of the issues to accompany that debt is while debt is very high, you don't have a lot of spending in South Africa. That's what this chart is showing. IMF predicting that we will see investment as a ratio of GDP be one of the lowest on records at just 13%. I should say the finance minister in South Africa also expects debt to peak in 6 years from now at 95.3% of total GDP, Francine.
Danny, that rate decision later today, what are we actually expecting?
Economists do expect South Africa to keep their rates on hold. Data does suggest that GDP over the last 3 months actually outperformed expectations. But at the same time, South Africa does face a lot of issues with their economy because of the more advanced economies that are locked down means that it's a weigh on their exports and output in the final quarter. But you have to remember the bank also really aggressively loaded rate cuts in the beginning of that year. So that probably is another reason that they're likely to hold still at this meeting, Francine.
Danny, thank you so much. Our Danny Berger there with the very latest on South Africa. Now, in the meantime, this is what markets are doing. Stocks are actually falling. U.S. futures are also seeing a little bit of pressure. There are tougher restrictions in many parts of the world, including New York, to curb the pandemic's resurgence. And that seems to be overshadowing progress towards a vaccine. I mean, it really depends on the day what the market decides to focus on. Bloomberg Surveillance continues in the next hour. Tom Keene joins me out of New York. Stay tuned for more from the Bloomberg New Economy Forum as well. This is Bloomberg.
The big concern is climate change. We can see the global warming accelerating at the moment, and the goals that we must hit are so ambitious. It's 1.5 degrees by 2050, being climate neutral in terms of emissions by 2050. That's a huge challenge. We have to reduce emissions by 50%, 2030, 2040 again. It's very, very ambitious, and mobility plays such a crucial role in there. One thing is to do it in developed countries. I think we're going to get there by 2030, but then the rest of the world, and that's just as important. If you look at developing countries, emerging countries, that's where probably the biggest challenge we are going to face, to also deploy EV mobility forward fast enough to be able to do its part in this fundamental threat that we're facing.
The Bloomberg New Economy Forum brought together over 600 leaders to discuss the most pressing economic issues facing the world today.
Join us as we recap the important conversations from the week on our New Economy Forum special this weekend on Bloomberg Television.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The vaccine race, a phase 2 study, confirms that the Astra-Oxford vaccine provokes an immune response in elderly patients. A phase 3 trial looking at its results is expected within weeks. U.S. deaths from the coronavirus reach 250,000. New York City shut schools once again. The country deals with the surge in cases from coast to coast. And EU leaders will attempt to salvage billions in virus relief today. Hungary and Poland threaten to derail the plans. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lacqua here in London, Tom Keane in New York. Tom, we'll spend a good amount of time looking, of course, at the resurgence or the continuing restrictions because of the vaccine, and the market today decided to focus on that instead of the encouraging news we had from the vaccine. So we look at your New York schools with, working parents really having to try and deal with that and find a solution. And then we look at Europe and some of the reimbursements that may be in jeopardy because of Poland and Hungary.
What's out there within the markets, and it's a churn of the markets, but Francine, I would really look at a disinflationary dampening you're seeing out in the bond market. I don't want to make a big deal about it, but yield just gives way to a lower yield. I'm looking at five-year break-evens going out for the different countries, and there's just a little bit of an ebb there, an increase, if you will, in the disinflationary tendency. Francine, jobs report, that claims number at 8:30.
Yeah, a really important one. And then we also have some great interviews coming up from the Bloomberg New Economy Forum focusing on health today. I think a conversation also with Bill Gates. Now let's get straight to the Bloomberg First Word News in New York City is Ritika Gupta. Hi, Ritika.
Morning, Francine. Tom. Joe Biden warns that the delay in starting the presidential transition could set back the efforts to distribute a coronavirus vaccine. The General Services Administration has refused to begin the transition process, while President Trump challenges election results. The leaders of the National Association of Manufacturers is urging the Trump administration to begin working with Biden. In Wisconsin, election officials have ordered a partial vote recount that was requested by the Trump campaign. There will be recounts in 2 heavily Democratic counties. Joe Biden won Wisconsin by more than 20,000 votes. Recounts have historically shifted only hundreds of votes. The controversial nomination of Judy Shelton to the Federal Reserve Board is hanging by a thread, and there's little chance it will be revived. The Senate is preparing for its Thanksgiving recess. Once lawmakers return, Democrats will be picking up another seat. That makes confirming Shelton an even tougher battle. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thanks so much. Equities, bonds, currencies, commodities. There's a little weight to the tape. Futures negative 16. Dow futures negative 133. The VIX shows at 22. Out to 23. We're back up to 24.31. Some of the three-day angst that we've seen. Yields come in, as I mentioned. The 10-year yield, 0.85%. We're going to get a 0.84 on that in a moment with a tendon curve flattening. Oil finally pulls back after two interesting days. And dollar, well, a little bit of dollar strength here right now. Francine, what do you have?
So, Tom, I have a very similar data check to yours. Stocks are falling, and again, it's because of the pandemic's resurgence, and that today seems to overshadow progress towards a vaccine. But again, I feel like it just flips, day in, day out. So don't read too much into that. Amongst the bright spots, AstraZeneca rising after releasing positive results on its COVID-19 vaccine. And then I'm also looking at pound. Always look at pound, Tom, because there's another deadline, and we also have to talk about Brexit. I want to show you renminbi, actually. I don't think I have it in my data check. But I was looking at, some of the new calls from the new research chief of HSBC, and they say yuan is now a G10 currency. And I thought that was very significant, Tom. Now, the European Union also faces a grueling battle to save billions in relief funds. Leaders will try to persuade Hungary and Poland not to veto the recovery plan. And now, European Commission President Ursula von der Leyen spoke about the joint effort at the Bloomberg New Economy Forum.
This crisis has shown us that global public health is the foundation of the world's prosperity and security. Safe vaccines must be available for all, whoever they are, wherever they are, whatever they can afford. No middle or low-income country should be left behind. A global recovery is the only way to reopen our economies, to restart the labor market, to repair supply chains and start rebuilding. This is about capitalizing on existing market forces, not fighting them. We need to use our recovery stimulus to invest in the clean and digital technologies of the future. This is the thinking behind Europe's 1.8 trillion euro recovery package. You can count on Europe to lead the way.
And as we're speaking, there's also Christine Lagarde speaking at the European Parliament, promising a forceful monetary stimulus package in December. She's also urging governments to make pandemic relief available without delay. There is Madame Lagarde speaking live. We'll monitor any headlines from that. Joining us now is Elsa Lignos, RBC Capital Markets Global Head of FX Strategy. Elsa, great to speak to you today. How much of a concern is it for Euro if these pandemic relief efforts are delayed significantly because of vetoes?
I mean, I think it would be a concern if they were to be delayed indefinitely. But our experience with European leaders has been that they always find some way to either bend the rules or find a workaround and get done ultimately what they want to get done. In this case, getting the EU recovery fund off the ground. So I can see that there will be an almighty battle today. I doubt that they'll find a compromise on today's conference call. But I think market participants are quite rightly expecting that one way or another it will get done and the funds will be dispersed.
What does it mean for Euro, Elsa?
For the Euro, I think so far it's not really traded on the back of these news, and that's probably the right approach. You saw a big rally in Eurodollar earlier this year. I don't think it was just down to the recovery fund. I mean, it was a combination of factors. I think the last time we spoke in person, Francine, which was probably a while ago now, we were looking for Eurodollar to hit that 120 level. And I think the rationale behind it was really that collapse of US rates towards European levels. But that's now run its course. The EU recovery fund mostly baked in. And so I don't think you're going to be really seeing Euro trade meaningfully on the back of this. The exception would be if the whole thing was called into question. But like I said, that's not anybody's base case at the moment.
Elsa, Tom Keene, wonderful to have you back on the show. Elsa, I really want to ask you the more philosophical question of, given weak dollar, at what level do you perceive different nations will start screaming? This is a huge mystery. You look at Plaza Louvre, you look at the early 1990s, and the distinctive issue is now like then, where they take a while to scream, or do they scream much sooner than we expect?
I think some people are screaming already, but it's a great question because it comes to the heart of what can countries do to prevent their currencies from appreciating. And I think in emerging markets and in certain G10 ones as well, the SMB is a notable example, the answer is active intervention, reserve accumulation. But in other countries, and the Eurozone is one region in particular, you do have this approach which is, hands off, market-determined exchange rates, we can't get too heavily involved. I've heard a number of clients say to me, the ECB will not be happy if euro-dollar trades through 120. And the answer is, okay, but what will they do about it? I mean, the reality is it's not like they can cut rates a lot further. It's not like they've got a lot left in terms of conventional monetary policy tools.
Well, what they've done historically, and correct me if I'm wrong, but they've asked the United States to stop a weak dollar policy. It seems like out of another time and place. Most of the interviews we do suggest euro 130 or even 140 would provide that tension. And I'm hearing too many adults like you say, no, that's wrong. We could see the screaming at 122, 123, whatever. Why is that? Why would they, is it just at the zero bound and with negative interest rates? Things are so much more sensitive now?
Maybe a part of it, but also I think it's a recognition that there are limited tools. I don't think anybody would expect a Plaza Accord or a Louvre Accord repeat, certainly not an explicit one, because we've moved so far away from that policy of coordination, intervention. The last time we saw something similar was Fukushima, of course, and there's very specific circumstances hitting Japan in particular. I mean, this is a global pandemic, and I think currencies are going to adjust appropriately. I'm unusually not in the bearish dollar camp. I know most of the people you speak to are at the moment. And I actually think the market will do the work for the ECB, because if the US has a better economic recovery next year or the year after, then actually you'll find euro-dollar drifting back down through no intervention from the ECB at all.
Elsa, thank you so much. Elsa Lignos there of RBC Capital Markets stays with us, and we'll talk a lot more about some of the currencies out there. I want to talk to her about renminbi. Now, coming up at the Open, Loretta Mester, Federal Reserve Bank of Cleveland president. I know Tom wants to talk about jobs and, of course, inflation. That's at 9:30 a.m. in New York. That's 2:30 p.m. in London. And this is Bloomberg.
Every era presents its own unique set of challenges and opportunities. Trade CME Group futures with Interactive Brokers at low cost and seize the moment. Start investing today at interactivebrokers.com.hk.
Bloomberg Surveillance. Good morning, everyone. Francine Lacroix in London. I'm Tom Keene in New York. Thursday, jobless claims, a big deal at 8:30 New York time, Washington time this morning. Right now in foreign exchange, we're thrilled to bring you Elsa Lignos, RBC Capital Markets, a spirited discussion on euro, on, a dollar weakness she's not convinced on. What we are convinced, Elsa, is renminbi is on a tear. Let's start with the why. Why have we seen yuan appreciation?
I think part of it is that's because policymakers are letting it happen. We all know that the PBOC has a large say in direction of renminbi. But also, market participants are rightly looking at China's response to the virus and the economic recovery that has taken place there, and saying they've handled it better than a lot of places. Our Asia strategists and our Asia traders as well, I think, had a really good call earlier this year looking for renminbi strength. But I do think we're getting to the point now where that path of one-way appreciation for the renminbi is running to an end.
Well, it's running to an end. Okay, fine. We've got a new stasis there. Is that strong yuan or is that fairly priced yuan?
I think it depends the approach you take. If you look at kind of current account position, there are still people who would argue it's too cheap. And then obviously there are all the longer term concerns around the debt sustainability for China, which point to the yuan being too strong. I think for the moment it's a sustainable level, and that's really all that matters for markets. It's really interesting for me to see, for example, dollar renminbi vol trading actually above euro-dollar vol on a one-year horizon. And that doesn't make an awful lot of sense to me, at least, because I do think that we're moving into an environment where you may see a more normalized US-China relationship going forward.
Elsa, what do you make of yen? It seems pretty range-bound. I don't know what you do with some of the havens, be it Swissy or yen right now.
So we've actually been tactically short dollar yen, and not because we are bearish on risk, because actually the relationship between dollar yen and equities has weakened quite a bit this year, and not because we're hugely bearish on the dollar either, but because I think you're seeing a very interesting capital flow story with repatriation of money by Japanese investors back into domestic assets. And they become natural sellers of dollar yen on any rally. So we've had that position on a few times in the last few weeks. We've got it on again at the moment. Our target right now is 103. Not a huge move, but it's making a bit of money for us at the moment.
So there's a lot of talk about the EU and the UK coming closer to an agreement. We see another deadline, and then we also have reports from the UK press saying the EU leaders worry that actually business are just not ready for a no-deal Brexit. I mean, we're still talking about it, and we're like 3 or 4 years on. What happens to how much higher can pound go from here if we have a deal?
Yeah, we, like you say, still talking about it 4.5 years on. I mean, it seems amazing now, but that was mid-2016, and here we are still talking about how we're going to properly exit. I think the important thing to bear in mind is that no matter what happens, whether we get a deal or not, the UK is leaving the single market at the end of the year. And that means economic disruption in any case. And I think when you're looking at sterling, it's important to bear in mind that, yes, you may get a knee-jerk rally on an announcement of a deal, but that may well be a very good opportunity to sell into. I'm looking at it the way we did the UK election last year, where there was this expectation that Tory victory would be very positive for sterling, and actually you just got a rally the night of the election results, and from then on we've never seen those levels again in cable. So I wouldn't be surprised to see something similar happen in this situation. Whether we get a deal or not, trade is going to be less free at the end of this year than it was up until this point.
Elsa Lignos, thank you so much for joining us this morning. Ms. Lignos with RBC Capital Markets, Global Head of FX Strategy. Really interesting nuance there on Euro as well. Speaking of nuance, it is a nuanced story at the border. The Dallas Fed President, Robert Kaplan, with David Weston, balance of power. Look for that at 12:30. Right now, futures deteriorate, -20. The VIX, 24.32. Stay with us. This is Bloomberg.
It came in better than expected, not only in terms of job creation, but also a sharp fall in the unemployment rate consistent with higher labor force participation. That's really good news.
Overall, the gain was solid, but even while this is a very robust pace of job gains, it's a lot slower than it has been in the summer months.
Great that we saw the job gains we did, but they still are diminished from what they were, of course, back in April and May. And the scarring, the sort of wounds that were created by COVID are beginning to fester.
I would caution people to look at the top line number because I don't think it tells the entire story. Employment relative to population is still well below where we were pre-crisis, and that's because I think that we're going to have some lasting damage.
Depending on what you look at, jobs creation or the unemployment rate, you have different views as to whether the improvement in the labor force is keeping up or slowing down.
Our aim was from the beginning to have a portfolio of 6 to 7 potentially safe and effective vaccines. We've signed with AstraZeneca, we've signed with Sanofi and Johnson & Johnson. We will leave no stone unturned.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
The anti-vaccination movement has mobilized, it's growing, it's active, and it's dangerous. And we need to see governments, we need to see public figures really working hard to defeat this movement. The vaccine science is good, it's safe, we need to take it one step at a time. If I think about President-elect Biden coming in, his #1 objective for him and his advisory group that he's formed is to rebuild public trust. And then you can protect that progress that we're all hoping for in 2021.
Well, that is the Lancet editor, Richard Horton, speaking to me earlier, and we were talking about the anti-vax movement. Now, a study in the medical journal confirms that the AstraZeneca-Oxford vaccine provokes an immune response in the elderly. Meanwhile, in the United States, deaths from the virus have topped 250,000, and New York schools have closed. Joining us now to round up all of the news is Sam Fazeli. He's Bloomberg Intelligence Senior Pharmaceuticals Analyst and Director of EMEA Research. Sam, when you look at this vaccine, it's a different vaccine to what we heard from Pfizer and Moderna. Is it easier to distribute, or is it just not as effective as the other ones?
Yeah, so for the effectiveness, Francine, and good morning, we have to wait and see how it works in phase 3. All these studies that they do in early trials look at activity as opposed to efficacy. So it's something that we have to wait for. And yes, if this proves as effective as the other vaccines that we've seen so far, it's much easier to handle. It only needs refrigeration when you're transporting it, and it can remain in the fridge for quite decent length of time.
Which one will get approved first? I mean, the other two, the Pfizer and Moderna, are actually new. There are certain, they're a new type of vaccine that you were explaining to us very clearly yesterday. Does regulatory approval come later for those?
Yeah, no, I don't think so. I think they're way ahead of AstraZeneca. So the FDA has a review meeting between the 8th and 10th of December for both vaccines. So I suspect they're both going to be, unless there's something wrong in manufacturing or whatever, seeing an emergency use authorization sometime before the end of December. AstraZeneca will be a little behind, certainly in the U.S., possibly in the U.K. they might get approval before the end of the year, but more likely into Q1.
Sam Fazeli, I want to talk about when we get the vaccines. I get the idea, and it's all over the media, about it's going to be essential workers and the very old and the sick, etc. When does a 9-year-old kid in Des Moines, Iowa, get a vaccine for COVID?
Oh, well, so I suspect that sort of age group will have to wait for, if that is what the states do and the health authorities do, go by age group and by susceptibility to disease, then I suspect they'll have to wait for it probably back in the next year.
So back into next year, so what does that mean for the social response of cities and towns? I mean, I get the drama of a school closing, and I guess that folds into that discussion. But it seems to me like the single point date of the media, the vaccine's going to be here by March or the summer or Thanksgiving of next year. I mean, do pros like you have a clue when we can actually say all clear?
Yeah, so there's two things to think about that. One is, first, the vaccines have to prove that they have durability, that they last long enough in terms of the protection that they provide. And I think there's reason to think that they would. So that's one thing. Then, of course, it's not a black and white situation that the X number of people have been vaccinated. Okay, let's go. You're going to have to wait until you get to a meaningful 70-80% of the population vaccinated before you can really start thinking about this so-called herd immunity. Until then, we're going to have to keep social distancing and wearing masks. Hopefully no lockdowns, though.
But Sam, do kids pass, this thing on? Do they have COVID and do they pass it? Does it make sense closing schools, or because they're largely asymptomatic, the transmission rate is much smaller than, for example, in older kids?
Yeah. So, Francine, I think you guys actually spoke about a study that was done quite recently in using big data analysis that looked at where the most transmissions occur, and they were in restaurants, hotels, and gyms. I don't think schools particularly were highlighted in that study. So it's, of course, kids who get it, so long as they have the disease, can potentially pass it. But I don't think there's been any major link to an outbreak back to a school. So, but time can, we have plenty of time to prove that again. But so far, our worry should be more gyms, hotels, and restaurants.
And they are serious issues. Certainly in New York in the last couple days, the comments on a struggling hotel business is tangible. Dr. Fazeli, thank you so much for joining us literally on a daily basis. On this matter of the pandemic, the gentleman of the MTA at 8:30. This is Bloomberg.
Every era presents its own unique set of challenges and opportunities. Trade CME Group futures with interactive brokers at low cost and seize the moment. Start investing today at interactivebrokers.com.hk.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Tom Keene is in New York. Tom, we have plenty more, of course, on some of the emerging markets, and we really focus in on South Africa. The South African president, Cyril Ramaphosa, has reiterated his commitment to reining in the country's skyrocketing debt. Well, the president spoke to Bloomberg in Johannesburg.
Our investment have been going down in relation to our GDP, and one of the reasons why I, right at the beginning of my tenure as president, focused on attracting investment was to try to correct this. And we are in the process of doing so. We set ourselves a goal of attracting $100 billion into our economy in 5 years. And we are already more than halfway there. Commitments are being made by companies, and many of these commitments are actually being actualized. So attracting investment is in an effort to increase investment vis-a-vis our GDP, and I think we can turn things around quite significantly. But it also means that the public sector, which is government throughout its various entities, also needs to demonstrate its own confidence in the economy of our country. So public sector investment had tapered down, and we now want to boost that. And through the infrastructure play and through refocusing our state-owned enterprises, we are going to be able to do so. And in tandem, we will also see the private sector beginning to invest more and more.
Mr. President, how confident are you that South Africa can avoid a sovereign debt crisis? This, of course, a risk that the Finance Minister, Tito Mboweni, highlighted.
We have taken it upon ourselves to draw a line in the debt sand and have decided that we are now going to arrest the debt levels, bring them down quite significantly. Over the next 4 years, we want to see our debt being brought down. We're spending far too much money on debt servicing costs, much more in some cases more than what we pay for education. And that cannot be. We've got to bring down our debt levels, make them much more manageable, and we are embarking on a variety of schemes, be it stopping wastage, stopping corruption, and with all those measures that we are putting in place, I'm certain that we will be able to bring our debt levels down and avoid what you could call a debt crisis, because we are focused. And we've been open enough by telling them and as you get growth, you are then able
management. He has had a distinguished career thinking broader and larger about EM and about sovereign, the mix that's out there with his public service to the United Kingdom, and of course his work at Blue Bay Asset Management. And Tim Ash joins us now. Tim, I want to talk first of all, I know we'll get to Turkey and all the rest of it, about G20 and the absolute decline we have in multilateralism. How is that affecting emerging economies, which right now seem to be doing better with currency appreciation? Do they need a G20? Do they need a more multilateral post-Trump world?
Well, you know, Trump was about deglobalization, trade wars, every country for himself. And I guess, you know, in the end, over the last 4 years, what the world got was less global trade, less global growth, and the losers were generally emerging markets. And I guess the hope now with Biden, hopefully, well, presumably emerging as president eventually on January 20th is a reversal of that, an assumption that, there'll be a rethinking about globalization, more inclusive growth generally. I think that's really important to counter the threat from populists, but a more multilateral approach. I mean, just imagine the COVID shock. You were talking about it earlier. I mean, imagine if Trump or G20 leaders had met around the table, March, April last year, and we'd have had a coordinated response. I mean, it might have been very different in terms of the health impact and then obviously the impact in terms of the global economy. So in the end, markets at the moment are beginning to look a bit more optimistic about global growth, global trade and emerging markets in general. And EM currencies have done relatively well in the last couple of weeks.
We've got a mystery, Tim Ash, and you're the right guy to talk about it, which is Mr. Erdogan creating a new monetary policy within his domestic challenges as well. Has Mr. Erdogan taken the international economics Kool-Aid?
Well, he's an incredible character, right? I mean, he's a political animal. He's been in power 20 years. He knows how Turkey works in terms of the politics of the country, and he's been able to do big U-turns in the past, right? I mean, we're all focused on this MPC decision, right? And the assumption that Erdogan is going to bin his funny interest rate policies and is going to allow the new governor to massively hike interest rates, stabilize the currency. Well, Erdogan's done that before, right? 2018, 15, 16, 11, 06, 07. I mean, so he always takes it to the edge. And, and then he kind of pulls it back, right? And bottom line is they're going to hike today. I mean, that's pretty clear. Akbal is the new governor, is pretty orthodox. He gets it. He understands it. He knows if he doesn't hike, it's a disaster for the lira, right? And, what options does he have? I mean, Oysal, the previous governor, and Al-Barak blew 140 billion in FX reserves. Turkey has the cupboard's empty. There's no money in the cupboard left to defend the currency. The only way is interest rates, and Akbal has to do it. And Erdogan, in the end, gets that.
But Tim, how big a hike do they need? I mean, the hike needs to be big enough to actually shore up the currency. I think I was looking like the median average is people expecting some 475 basis points. Is that enough to get investors interested?
Look, I mean, two things. One, it's the level of rates. So base is 10.25, average funding cost is 14.75, more or less. We're all assuming Akbal can sell this as not a hike in many respects to Erdogan and his supporters because the average funding rate is 14.75. If he moves it to 15, he can say, well, we're just normalizing the rate. I think they will go to 15, and I think they'll sell it. Akbal will try and sell this as a simplification of the regime, and the market wants that. The market doesn't like this kind of interest rate corridor kind of bull that has, smoke and mirrors, hiding to the domestic audience what they're really doing about interest rates. They want a clean, plain vanilla rate hike, and they want one policy rate. And I think that was going to go to 15% at least today. Now, you said about disappointments. I mean, look, if they don't do that, I mean, I think, a lot of money's been poured back into Turkey, into the Turkey trade, since Oysal was fired and Al-Barak disappeared.
I believe that was a noise. Tim Ash, you still there?
I think I am, yeah.
Okay,
Someone was trying to stop me there.
I don't know what that was. That was the miracles of remote. But here we are. Tim Ash, let me pick it up, just to continue this discussion forward. And it is on Turkey. It's also on the dollar position here on EM. What does a Biden administration do? Do they continue with discussions of currency manipulation? How do they address what I'm going to call almost a renaissance in emerging markets?
Again, I mean, this idea, Biden's team, a very rational, very professional team of technocrats. I mean, the big issues geopolitical wise are Russia and China. And obviously China, I mean, it's a bit hard for Biden to go soft on China, right? I mean, so, all the sanctions stuff we've seen this week on China, I mean, in the end, if the Senate stays with the GOP, they're going to still be banging on Biden's door about China. And, again, look, we have to recognize 2016 and the sort of the Rust Belt story. So, so I don't think there's going to be any particular let up on China. But I think, I don't think Biden's going to be aggressive in terms of the trade war story. And I think he's going to be reaching out to allies like Europe to try and improve and normalize the relationship, but make global trade fairer for everyone. And I think, I think we'd all respect that fact that some players like China have played the system to their advantage, which, everyone does, I guess.
Tim Ash, thank you so much. Wonderful to have you with us. Timothy Ash with Blue Bay Asset Management on EM. And folks, I think this is a story for 2020. And it's going to be really interesting to see the thought pieces into 2021 on this new relationship of an America to EM, and particularly to the Pacific Rim, with what we've seen with ADXY surging, stronger EM, stronger Pacific Rim currencies. With our first word news in New York City, here's Ritika Gupta.
Thanks, Tom. The Trump administration has assured states they'll have enough hospital beds and equipment to handle the surge in coronavirus cases. But it's not doing anything to slow the virus's spread. And the Trump team continues to shut out Joe Biden's advisors. Vice President Mike Pence says the media have been crying wolf about the disease. The job picture in the U.S. has gotten worse as the number of coronavirus cases rises. According to the Census Bureau, the number of employed Americans fell by about 4.5 million from mid-October to mid-November. Amongst the jobless, 4.2 million said they were sick with coronavirus or caring for somebody with symptoms. New York City's prospects of recovery from the coronavirus face a double whammy. The subway system could be crippled by big budget cuts unless Washington comes to the rescue. Plus, public schools are ending in-class instruction for at least 2 weeks. That's forcing parents to find alternative childcare arrangements or adjust their work schedules. And European Central Bank President Christine Lagarde is promising a monetary stimulus package for next month, and she's urging Eurozone leaders to do their part.
The next generation EU package must become operational without delay. This is critically important.
Lagarde says European leaders should make joint fiscal support a priority. Europe is expected to be severely affected by the rapid increase in coronavirus infections. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine.
Thank you so much, Ritika. Now coming up, a Bloomberg Capital Markets Forum, Spain, moderated by our Maria Tadeo. Of course, amongst the people interviewed, the Spanish economy minister, Nadia Calvino, and the Bank of Spain governor. That's coming up a little bit later, 10 a.m. in New York, 3 p.m. in London. I think you can watch it on the Bloomberg terminal. This is Bloomberg.
Every era presents its own unique set of challenges and opportunities. Trade CME Group futures with interactive brokers at low cost and seize the moment. Start investing today at interactivebrokers.com.hk.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
We've been shouting from the rooftops for a very long time. There is a monopoly problem in this country, and in particular, there is a Google problem in this country.
We see an opportunity here to have a recovery in 2021 that is green.
We need to invest now. I mean, we're touch wood, we're going to be coming out of the health and economic crisis. The question is, what direction are we pointing our economies? We're going to point towards sustainable growth.
There's no planet B. Sometimes in business, you have a plan B for something if plan A doesn't work. In our planet Earth, there's no planet B.
We need to use our recovery stimulus to invest in the clean and digital technologies of the future, to make our economies more resilient and our societies and job markets fairer.
Until the private sector has economic incentives to get there, the reality is that everybody will continue to act in what they think is their best interest.
There's a range of things we can do. In the end, though, we're not going to set carbon policy or climate policy. Governments are going to do that, and the private sector is going to provide the solutions.
Electro-powered aircraft, another area of focus for us, which is the technologies aren't available here yet today, but they'll be here 2, 3, 4 years from now.
Reality is, who is the villain in this story? Are we supposed to punish those people by blacklining industries and blacklining companies as investors? Or, should we be blacklining the people who are just indiscriminately increasing the demand for carbon production?
This was phenomenal. The Bloomberg New Economy Forum on green. I was about ready to nod off and go to sleep. And I thank Geeta Gopinath of the IMF and particularly Scott Meinard for really driving forward that conversation on all the things of green and climate change at this moment, the idea of folding economics into how we advance forward. And some of that, I will be blunt, comes out of the Paris Accord, and maybe we'll see a renaissance of that with a President Biden. Right now, to fold this into the renaissance, into the cyclic change of the moment, is Thomas Orlik. He is Bloomberg Economics chief economist, and far more, his acclaimed new book, China, The Bubble That Never Pops. And in there, Tom Orlik, you talk, and this is sort of a green thing, but Tom, it's much more about what Biden will do. You talk about the China third cycle. What's the first cycle for President Biden?
So great to be here, Tom, and good to hear those clips from the NEF where the focus was, I think, on two big subjects, China and the US, and then how to combine the recovery from the COVID recession with the fight against climate change. Now, for President-elect Biden, I think both of those issues are going to be jostling for attention at the top of the agenda. First, is it possible to walk and chew gum on China? Can the two sides cooperate where there's space for cooperation while still fiercely competing and speaking their minds in other areas? And then secondly, as you say, climate change. Biden has signaled that he's going to rejoin the Paris Accord. Can the US get back to a leadership position in the fight against climate change, or has too much credibility been lost in the last 4 years?
Well, let's go back, Tom Orlik, to Elizabeth Economy, who that thesis she had out of Michigan, The River Runs Black, which was an acclaimed book. Give us an update on how China, with your expertise there, how they fit into a Paris Accord discussion. Is Chengdu going to be part of the Paris Accord?
Yeah, so it's interesting, Tom. Climate change sort of figures in these big international meetings as a kind of kumbaya concept, right? Let's all come together over climate change. And of course, as one of the speakers you had in that role said, there's no planet B. So ultimately, we do have to come together. at the same time, the costs and benefits of fighting aggressively and effectively against climate change are not evenly distributed. China faces bigger costs as temperatures rise. They also are potentially bigger winners if the world moves quickly towards sustainable energy. They've got an advantage in solar, wind, and other areas. The United States, yeah, they face some costs if temperatures rise, but they're not as severe as the costs which China, India, and other emerging markets face. That's one of the reasons why, even as we expect a pivot from Biden, that uneven distribution of costs and benefits makes global agreement so hard to achieve.
Tom, good morning from London. Does that mean that debt relief is probably going to be the most contentious point in 2021?
So, hi, Francine. So the COVID shock has triggered an extraordinary increase in government borrowing. And if it were 10 years ago, alarm bells would be ringing. We'd have the fiscal hawks, we'd have the bond market vigilantes saying this isn't sustainable. Right now, the debate has really moved on. We're in a world of what looks like sustainably low interest rates, and that means everyone from Larry Summers to the International Monetary Fund to Wall Street economists are just less stressed about debt. Yes, ultimately, that money is going to have to be paid down. It's not going to be an immediate priority for 2021. Something which should be higher on the agenda, and we need to think more about, is how we get back to the debt relief agenda for developing economies. We'll see if that bubbles up or not.
Tom, I know you actually, gave a great presentation at the New Economy Forum looking at the world in 2050. Now, 2050 for many people feels like, a million years away. But what will be the main difference from now until 2050 if we don't readjust and readapt our economies?
So we modeled three things, Francine. We looked at a base case projecting growth out to 2050 for China, the US, all the world's major economies. And then we layered on top of that scenarios for globalization, whether global ties advance or start to fracture, and scenarios for climate change, whether the world gets to grips with the climate change challenge or fails and allows temperatures to continue rising. The big takeaway is that the difference between a cool and coordinated planet where globalization is on track and we fight effectively against climate change, and a hot and fragmented planet where we get both of those things wrong is really immense. By 2050, it adds up to $36 trillion in global GDP. That's roughly equivalent to the entire output of China and the United States.
Tom Orlick, thank you so much. Greatly appreciate it. Bloomberg Economics chief economist this morning. Futures at -11. This is Bloomberg.
generation's biggest problem.
Climate change is happening.
Every era presents its own unique set of challenges and opportunities. Trade CME Group futures with interactive brokers at low cost and seize the moment. Start investing today at interactivebrokers.com.hk.
Fight against climate change. Bloomberg Green has you covered.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Tom, the markets are really struggling for any kind of clear direction. I think every day it flips, Tom, and the two stories that we laid out very, very clearly is, on the one hand, we have better news on a vaccine. On the other, it's more restrictions and also the number of infected around the world rising. And I think the market is struggling to put the two together. So one day it falls and one day it rises. And today it's focusing on New York schools being shut and more restrictions around the world. You can see European stocks down some 0.8%. And then I'm looking at pounds simply because the Brexit negotiations continue. But we have a new deadline days away, 132.49, Tom.
I noticed as well, oil finally giving it back a little bit. And gold really having a struggle here. It's down $18, $18.56 the ounce on what I'll call American gold. We've got much more for you. Lots of good conversation on a Thursday. Mark Chandler joins on foreign exchange. Mark Chandler on the astronomy of international economics. This is Bloomberg. Good morning.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you? Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
This morning, deaths rise, not as fast as cases. America counts 250,000 deaths. New York City, it closes schools. In South Australia, you cannot walk a dog. Bitcoin, well, Bitcoin to the moon. Gold crushed. And equities, well, they churned this morning. In the 75-foot Norway spruce at Rockefeller Center, it came attached with a tiny 4-ounce saw-whet owl. We named it Rockefeller. Rockefeller is resting fine after the all-you-can-eat mice buffet. He will be released into the La Croix backyard in London. Good morning, everyone. Bloomberg surveillance from New York, from London. We are waiting right now, the Turkish rate decision. Francine, to frame this up, this is a massive, massive change and capitulation of Mr. Erdogan to the wishes of international economics. The one moment headline of a stunning 15%. But what's fascinating, Francine, is the market has moved so fast that it's basically the Turkish government catching up with the market. It'll be interesting to see what lira does.
Yeah, Tom, but it was important because we were speaking to Tim Ash before about it, and 15% was a psychological level that a lot of market participants were expecting. I think there were a couple of strategists that were maybe saying they won't go as as high as 15%. It could go a little bit lower, but the fact that they actually increased by so much gives them, a good idea that the central bank, at least for now, is independent. And if you look at option traders, they were hedging against the risks that Turkey Central Bank did not deliver a rate hike. So actually, this is probably a big relief, the fact that it's not only a rate hike, but it's big enough to shore up the currency for now.
I'm going to make a rule. We're going to put a headline up showing you what the pros look at, which is the standard deviation move in a currency. If you get that headline up, Matthew, that would really help. A 2 standard deviation move right now, given the recent betting of the market on lira, gets you out to 7.44 lira per dollar. We're not there yet. It's 7.53. We've moved stronger lira, but we're not out to what would be called the end of the envelope, a stronger lira. That will be interesting to see. Francine, to me, it's not so much this was in the news.